You are the CEO of a highly profitable startup. You have spent a decade pouring your sweat into building this company. Today, you sit down across from a brand new co-founder and slide a contract across the table. This document grants them completely unrestricted access to your bank accounts. It hands over 50% of everything you have built and 50% of everything you will ever build. Oh, and you didn't check their credit score, verify their resume, or even ask to look at their financial history. In the corporate world, executing a blind agreement like this is professional suicide. Your board of directors would fire you before the ink dried. Yet millions of intelligent people execute this exact merger every single year. We just call it marriage. We will spend weeks reading reviews to find a slightly lower expense ratio on a mutual fund. But we walk into the highest stakes legal contract of our lives, guided almost entirely by dopamine and oxytocin, completely ignoring the balance sheet. Beyond the obvious threat of divorce, this invisible contract carries a silent tax. It is a slow bleed that can drain millions of dollars from your portfolio without you even noticing it's happening. To protect your future, we have to take the romance out of the equation for a few minutes. We need to look at marriage through the cold, hard lens of forensic accounting, because financial incompatibility is the silent killer of wealth. We are told that opposites attract. That might work for movie preferences, but when a disciplined saver marries a chronic spender, it creates the spender tax. These are the everyday micro decisions, constant car leases, lavish vacations, buying lunch out every afternoon, that quietly drag down the household's overall saving rate. This chart shows the baseline trajectory of a disciplined saver. By investing $20,000 a year at an 8% return for 30 years, you reach multi-millionaire status with over $2 million. But watch what happens when the spender tax is introduced. The partner's lifestyle inflation consumes an extra $15,000 a year. The household savings rate plummets down to just $5,000. The math on that new reality is brutal. Over that same timeline, the portfolio peaks at a fraction of its potential. That daily consumption habit creates a massive gap, a $1.5 million penalty. The psychological toll this takes is heavy. The saver is forced into the role of the household police. Eventually, the emotional friction of striving for excellence gets too high, and they surrender to financial mediocrity simply to keep the peace. You don't need a massive, tragic divorce settlement to lose a fortune. A partner's daily spending acts as a permanent parasitic drag on your ability to reach financial escape velocity. As painful as that slow bleed is, it is mathematically preferable to the alternative. Roughly half of all first marriages fail. When that happens, the financial efficiency of having two incomes supporting one household is instantly shattered. This pie chart illustrates the true destruction of divorce. On a $500,000 net worth, you might assume you walk away with an even half, but that ignores the transaction costs. A heavily contested divorce incurs $50,000 to $70,000 in legal fees, plus the realtor fees and closing costs of being forced to sell the family home. Then comes the forced asset liquidation. To pay off a judge's settlement, you often have to cash out 401ks or sell stocks at the absolute worst time in the market, triggering heavy tax penalties. By the time the dust settles, you have lost 60 to 70% of your total purchasing power, and the drain continues for years. If you are the higher earner, you can be legally obligated to pay thousands of dollars a month in alimony and child support to maintain your ex-spouse's marital standard of living. I have seen individuals making $200,000 a year forced into studio apartments. Their disposable income dropped below the poverty line. Divorce operates as a permanent liability on your personal balance sheet, creating an active, long-term debt that transforms a former partner into a recurring expense. This vulnerability brings us to a severe threat: financial infidelity. Roughly 40% of Americans admit to secretly hiding debt, concealing purchases, or outright lying to their partners about money. Because marriage legally merges your economic entities, you are liable for their behavior. If your spouse secretly runs up massive credit card debt or takes out sketchy loans, creditors can place legal liens directly on your shared marital assets. You are entirely tethered to their credit score. You are swimming in the deep end with a partner who has the legal authority to secretly tie weights to your ankles. If the downside of this contract is total financial ruin, why do the wealthiest people in the country still use it? Because when executed correctly, it is an exponential wealth multiplier. It starts with the dual income, no lifestyle phase. This is the period where two high-earning individuals choose to live entirely on one income while aggressively investing every single dollar of the other. This comparison shows the pure economies of scale. On the left, a single earner bears the full weight of household overhead. On the right, a married couple cuts their living expenses in half while instantly doubling their tax-advantaged spaces. You now have two 401ks and two IRAs to max out. This also changes how we should view the stay-at-home spouse. They are an internal employee taking on massive career risk, sacrificing 20 years of resume building to generate sweat equity for the household. Viewed through this lens, alimony is simply a necessary severance package for that sacrifice. A financially aligned marriage allows a household to scale its investments through shared overhead, providing a significant accelerator for building wealth. To de-risk this decision, you need an actionable playbook. First, mandate extreme financial vetting. Before you ever buy a ring, you need a transparent money date. Put the books on the table, check the credit scores, look at the student loans, and verify the daily spending habits. Second, secure a prenuptial agreement. A prenup is an insurance policy that protects both of you from the arbitrary rulings of a random judge. It shields your premarital assets and explicitly limits your exposure to your spouse's hidden debts. If you are already married to a spender, you have to separate the finances today. Set up a yours, mine, and ours banking system. Automate your investments directly out of your paycheck to build unshakable guardrails against impulsive behavior. Ultimately, who you choose to marry is the single biggest asset allocation decision of your life. You are allocating your precious time and your entire future earnings into a single partnership. Applying professional due diligence to the marriage contract stabilizes the partnership's economic foundation, ensuring the household's assets continue to compound.